I hate high margin businesses. That's what one of the most famous VCs in the Silicon Valley said to me when I was pitching him to invest in our high margin business. I was stunned when he said this to me. After all, aren't high margins good because the business will be more valuable, right? I've raised over $100 million in venture capital and private equity funding, and I've helped entrepreneurs like you raise rounds between $50,000 and $150 million. In today's video, I'll explain why VCs are incentivized not to care about profits, why you should care about profitability in most cases, and when your startup should be profitable. Hi, I'm Brett. On my channel, I help early stage startup CEOs like you raise money and grow your startup. So if this sounds like you, then hit the subscribe button and the bell so you get notified every time I release a new video. Let's get started. Why don't VCs care about profitability? Let's say you have a business where with $1 million investment, you can get your startup to profitability. Your company in 3 years has the potential to be at $1 million in top line revenue and be generating a small profit. Additionally, the company has the ability to grow to $10 million per year in 5 years. Now that's a great business. Now let's say your best friend starts another business in a totally different market. The business is very capital intensive and your friend's business needs $100 million just to develop its product. But the end market for this company is over $50 billion per year. Which business will venture capitalists find more exciting to invest in? It's likely the second business, not the first business. The reason is the business potential determines the investability of a startup, not its profitability. That's why the famous billionaire VC wasn't impressed about our high margins. He only cared about whether our business could be one day worth over $1 billion. There are many examples of successful startup exits where the company had a valuation over $1 billion and the company was losing tons of money. The most famous example is Uber. At the time of its IPO, Uber was losing huge amounts of money. Here's a summary of what they said in their S-1 filing for their IPO. Uber had operating losses of $3 billion in 2018. Uber had operating losses of $4 billion in 2017. Uber has an accumulated deficit of $7.9 billion to date when they IPO'd. But Uber had a valuation of $69.7 billion after the first day of trading. So why should you care about profitability? So profits and profitability be damned, right? Uber didn't need to be profitable. VCs don't care about profitability, so why should you care about profitability? Well, here's why. Your next round of funding is never guaranteed. Raising money is tough right now, and who knows how long the market will remain tight. There are lots of startups that were able to raise money, lots of money, and now can't raise their next round of funding. It's a real problem. For example, let me tell you the story of Graphcore, a UK company that's building processors for high-performance computing. Graphcore has raised $682 million to date, and they had over 600 employees. They had a valuation of $2.7 billion. The problem was Graphcore had revenue of only $5 million and was losing over $180 million per year. They couldn't raise their next round of funding and they announced layoffs. This is what investors call burning a smoking hole in the ground. Now, Graphcore is still around, but I would be amazed if they survive. Now, when should your startup be profitable? Many investors are great at telling half-truths. One of the most famous half-truths is this: don't worry about how much money you're spending, we'll support you. I heard that line from my investors, and I'm sure many other CEOs have heard the same thing. I'm sure when investors say it, they mean it. However, they're not telling you the whole story. What they really mean is this: we'll support you until we decide not to. Here are some rules that can help guide you through this maze. Number one, run your startup as if your next round of funding isn't a sure thing. In other words, be appropriately frugal with your money. This leads to my second rule. Number two, don't spend ahead of achieving product market fit. It's one of the biggest mistakes that CEOs make. Let me explain what I mean. You have revenue and customers, so you expand your sales force and support team in expectation of the expected growth. The only problem is the growth never comes because you haven't achieved product market fit. The killer in this scenario is your burn rate has increased significantly and your cash out date has moved in. Now your company is in jeopardy of not being able to raise its next round of funding. Product market fit happens when you have a product customers want and a repeatable sales process that no longer relies on you, the CEO, to do the selling. Number three, get to profitability as quickly as you can without impeding the growth of your startup. Each business will have a different point where the profits of the business will fund its growth. You should develop financial models that show you where this point is. In my company's case, it was when we hit $10 million in revenue. Your number might be different. Now, if this content is resonating with you, then hit that like button right now. Here's a summary of what we've learned today. Number one, your company's potential valuation determines its investment ability, not whether it's profitable. Number two, you can have a money-losing business like Uber and have a high market cap, a very high market cap. Number three, you should care about profits because your next round of funding is never guaranteed. Number four, get to profitability as soon as it doesn't impede your growth. Now, what did you learn from today's video? Put your answer in the comments column below today's video. Now, I have one more thing for you. It's my free startup pitch deck template. It has all the slides you need to develop an awesome pitch deck. Click the link below today's video and it's yours for free. And for more great content, click the link on the video at the end of today's video. And if you haven't already, then click the subscribe button to get more great content for startup CEOs. I'm Brett at brettjfox.com. Thanks for watching today. Take care.